The broadcast is now starting. All attendees are in listen-only mode.
Okay, so hello and welcome everyone to this session of ACCA Financial Management F9 exam conducted by ACCA. This practice to pass webinar has a basic purpose of practicing as many questions as we can so that you get a sound revision of basic concepts, some past paper question practice, and you ensure that you perform well in the exam. Okay. Okay, in the last session, as I told you all, the objective of our last session was to cover some past paper questions of our first topic. Okay, and our first topic, which we discussed in the last class, that was investment appraisal. Okay, we were able to solve two past exam questions of investment appraisal in the last class. I want to tell you one thing, that if you check the past paper questions of 2018, 2019, 2020, 2021, since the last 4 years, there is extreme stress in investment appraisal questions on lease buy decision and on asset replacement decision and on capital rationing decision. That is why I focused on those areas, because if you check the last 4 years past papers, investment appraisal questions of finding NPV, IRR, ROS payback, they are not being stressed and focused by the examiner. The areas which are under focus at the moment by the examiner in these last 4 past papers are lease buy decision, asset replacement, and that capital rationing. That's why we cover them. Okay. Now in today's class, we will be covering our second topic, and the second topic which we are going to cover in our today's session after investment appraisal is going to be topic number 2. This is also considered a very core area of financial management exam. That's called WACC, or weighted average cost of capital. So today we will be focusing on WACC, or weighted average cost of capital. Okay. So when you talk about WACC, or weighted average cost of capital, this is also considered a very core area of financial management exam. Now, usually if I look at the past paper trend, there are multiple instances where WACC is tested in the constructive response question, section C question of 20 marks. And there are multiple instances where WACC, weighted average cost of capital, is also tested in section B, the OTQ or MTQ portion of 10 marks. And there have been some past papers in which WACC, or weighted average cost of capital, is tested in 20 marks section C, as well as an OTQ in section B. So total 30 marks can be gained from WACC. There are some attempts in which both questions have come in section C as well as that section B, OTQ. So make sure you have a sound grip on investment appraisal as well as WACC. Now, before starting WACC, since WACC involves some complex calculations as well, what I'm going to do is that I will firstly explain you some basic concepts of WACC. And once I explain you the basic concepts of WACC, then I can go towards the questions. Okay. So when we talk about WACC, or weighted average cost of capital, WACC, or weighted average cost of capital, is basically the cost of capital cost of raising finance. When you talk about the WACC, weighted average cost of capital is basically the cost of capital, cost of raising finance. And it is believed that company usually raises finance from these four sources. Either it raises finance from equity, ordinary shares. Remember, equity doesn't mean preference shares, equity only means ordinary shares. The company can raise finance through debentures or debt or loan note, or all same things. Okay, the company can raise finance from bank loan, and the company can raise finance from preference shares. So these are the four common sources through which a company raises finance. Again, WACC, weighted average cost of capital. Cost of capital is the cost of raising finance. Cost of capital is basically the cost of raising finance. A company usually raises finance from equity or debentures or bank loan or preference shares. Okay. Now we all know finance is raised via equity, that means issuing ordinary shares. We all know finance is raised via debentures, debt, loan note, by issue of debentures. It's raised via bank loan, it's raised via preference shares. So these are the four commonly used sources through which finance is raised. Now one might argue that there are also some multiple sources other than these four through which company can raise finance, but that is not covered in your F9 financial management portion of WACC. In WACC, you only believe that finance is raised either through equity or through debt or through bank loan or through preference shares. Now, what is the concept of this cost of capital? Remember, no matter through any source you raise finance, no one gives finance for free. You have to pay something in return to the finance provider. That is the cost. Okay? No one among these four will give you finance for free. Everybody wants some return. So you have to pay return to these parties. This is what cost of capital is, or cost of raising finances, that I have to pay return to someone. And when I pay return to someone, that's my cost. Like for example, when you raise finance via preference shares, they don't give you finance for free. You have to pay them preference dividend. That's a cost for the company. When you're paying preference dividend, that's a cost for a company called cost of preference shares. It's denoted by KP, because that's what the concept of cost of raising finance is. That when you raise finance via preference shares, you have to give return preference dividend to preference shareholders. That's our cost of preference shares, cost of raising finance, called KP. Similarly, if you raise finance via bank loan, the bank doesn't give you finance for free. You have to pay interest to them. That is a cost. If a company is paying interest, that's a cost. See, cost of raising finance. To raise finance, we have to bear a cost, interest. This cost is called cost of bank loan. It's denoted by KB. Okay. Similarly, if company raises finance via debenture issue or debt issue or loan note issue, again, no one provides them for free. People ask interest. That's a cost for the company. Cost of raising finance. This cost is called cost of debt, denoted by KD. Okay. And if finance is raised via ordinary shares, ordinary shareholders don't provide finance for free. They demand dividend. That's an outflow, cost for the company. This is cost of raising finance, called cost of raising equity, denoted by KE. So this was the basic concept of cost of capital. That cost of capital is the cost of raising finance. People ask how raising finance creates a cost. You raise finance via equity, via debt, via bank loan, via preference shares. You have to pay return to these parties. If you're raising finance via equity, you have to give return to equity holders. This is a cost, K. If you raise finance via debt, you have to pay interest to them. That's a cost of debt, KD. If you raise finance via bank, You have to pay interest to the bank. That's a cost of raising finance, cost of bank loan, KB. And similarly, if you have to pay preference dividend, that's a cost of preference shares, K. If you want, you can copy this, please. Salman, because we calculate this after we have paid dividend. That's why. Okay, so I have given you the basic concept of cost of capital, that cost of capital is the cost of raising finance, and company raises finance either through equity, has to bear a cost on that. Dividend, that's cost of equity, K. It raises finance through debt, has to pay interest on that, that's a cost of debt. If raises finance via bank loan, has to pay interest on that, cost of bank loan. Raises finance via preference shares, has to bear a cost on that, cost of preference shares, K. Now, the exam question from this topic will give you company's data. The exam question from this topic will give you company's data, and it will always give you a requirement to find WACC. Okay, the exam question of this section always comes like this: gives you company's data and asks you to find WACC. Now, when question asks you to find WACC, pay attention. When question asks you to find WACC, the approach is you should look at balance sheet to see from how many sources company has raised finance from, and make equation of WACC. Okay, this has to be your first step, because every exam question of WACC will give you this requirement: give you company's data and ask you to find WACC. So the first step is you should look at balance sheet to see from how many sources company has raised finance, because when you will look at balance sheet, you will get to know, okay, it has raised finance from 2 sources, 3 sources, 4 sources, and then you need to make an equation for WACC. How? Let me explain you. Let's suppose the question asks you to find WACC. What is WACC? Cost of capital. How much cost of capital or cost of raising finance companies build? Go in balance sheet and see from how many sources company has raised finance. Let's suppose you find company has raised finance through two sources, equity and debt. Make equation of WACC. If company has raised finance through two sources, equity and debt, it has to pay return to two parties. One, it has to pay return to equity holders, bear a cost called cost of equity K, and then it has to pay return to debt holders, bear a cost called cost of debt after tax, because debt is always after tax. The equation of WACC is going to be KE plus KD, because since company has raised finance from two sources, please pay attention to this, what I'm explaining. If company has raised finance from two sources, equity and debt, it has to give return to two parties, equity holders, debt holders. That means bear two costs. Give return to equity holders, bear a cost KE. Give return to debt holders, bear a cost KD. So the equation of WACC would be KE plus KD, but both costs will come on their proportions. KE will come on equity proportion only. So how do we get the equity percentage in the company? It's equity over all sources. Here there are two sources, equity plus debt. To get the equity percentage, we will take equity over total, equity plus debt. And cost of debt only on debt, that is debt over total. This is the equation of WACC. What is the advantage of making equation? Once you make equation, you are clear that how many variables you need, and this will help you very much in the exam, just to check when we will do the question. I am telling you the first step. When question asks you to find WACC, every question of WACC will ask you this requirement, find WACC. Look at the balance sheet to see from how many sources it has raised finance and make the equation. Let's suppose when it asks you to find WACC, you look at balance sheet and see company has raised finance from two sources, equity, debt. That means company has to give return to two parties, one to equity holders, one to debt holders, and bear two costs, K, cost of equity, and KD, cost of debt. So WACC would be KE plus KD on their respective portions. KE on equity proportion, that's equity over total. Debt on debt portion, debt over total. What is the advantage of this equation? Once you get this equation, you know which variables you need, calculate them, that's it. Let's suppose, pay attention. You are asked to find WACC. You look at balance sheet and you see companies financed through three sources. You look at balance sheet and see companies financed through three sources. Equity, debt, bank loan. Make equation. If it has raised finance through three sources, equity, debt, bank loan, how much cost of capital it has to bear? It has to give return to three parties. Bear three costs. One, give return to equity holders, bear a cost K. One, give return to debt holders, bear a cost KD, 1 minus T, because that is after tax. And it has raised finance via bank, so it has to pay return to bank as well, bear a cost KB. It's also after tax because it's interest paying instrument like that. The WACC equation would be KE plus KD plus KB, but all costs will come on their proportions only. KE will come on equity proportion. How do you get equity proportion among all three? It's equity over all three. E, B, B. Cost of debt on debt proportion only. How do you get debt proportion? On cost of bank loan, only on bank loan portion, that's B over. This is the equation if company has raised finance from three sources. And one last thing, then I will give you copying time. Let's suppose the question asks you to find WACC, cost of capital. That how much cost of capital company is bearing. Step one, you look at the balance sheet and you see company has raised finance from all four sources. There can be maximum four sources: equity, debt, bank loan, preference shares. Company has raised finance through all sources. If company has raised finance through all sources, it has to give return to four parties. How will equation be made? Company has raised finance from four sources. It has to give return to four parties, bear four costs. Give return to equity holders, bear a cost, K. Give return to debt holders, bear a cost. Give return to bank, bear a cost. And give return to preference shareholders, bear a cost. Only the interest paying instruments come 1 minus T, the others don't. So the equation of WACC would be KE plus KD plus KB plus KP. Because company has now raised finance from 4 sources, it has to pay return to all 4 parties. There are 4 costs: KE, KD, KB and KP. But again, all costs come on their respective proportions. KE will only come on equity proportion. So if company is financed from 4 sources, the equity proportion would be equity over all 4. E, D, B, P. Cost of debt on debt proportion only. That's debt over all 4. Cost of bank loan on bank loan proportion only. And cost of preference share on preference share proportion only. How do you get preference share percentage? Preference shares over all 4. What is the advantage of this? Once you make equation in step 1, you know which variables you need to calculate. So in step 2, calculate the required variables, and WACC is done. Okay. So when question asks you to find company's WACC, you must know that I'm finding cost of capital. I must know from how many sources company has raised finance. If you see company has raised finance from 2 sources, make the equation that you have to bear 2 costs, KE, KD on their proportions. If you see company has raised finance from 3 sources, then you have to pay return to 3 parties, bear 3 costs, KE equity holders, cost on debt holders, cost on bank loan on their proportion. And by chance, if it has raised finance to all 4 sources, give 4 costs, make the equation on their proportions. Okay, you can copy these equations. These are very golden equations. And if you have any questions, please ask. Hamza, the question will be answered obviously when I pause, because when I'm writing and explaining, I can't answer questions. So now I have seen your question and others' questions. I will respond you. And this thing which you're asking, that's from social of finance. We will cover it tomorrow, inshallah. Calculate the desired variables, required variables. No, it's not only debt, it is also equity. Ahmed Mashal. So if you understand these two steps properly, you won't have any difficulty in WACC. Hamza, I will tell you everything. Just to wait, because we haven't covered all aspects yet. So if you follow these two steps, your WACC would become very easy, because the concept is that obviously if someone asks you to find the cost of capital, you must see first that you are asking us to find cost of capital or cost of raising finance. Tell us from how many sources you have raised finance. This can only be told by looking at balance sheet. So that's why I've made this step one, that when examination question asks you to find cost of capital or WACC, okay, it's just two-step approach. First, asking cost of capital or cost of raising finance, go and see in the balance sheet and see from how many sources we have raised finance. Then only we can tell cost, once we know how many sources company has been financed from. So if it has raised finance from two sources, equity and debt, it must pay return to two parties. Equity holders, debt holders bear two costs, KE, KD, on their proportions, obviously. Okay. If it has raised finance from three sources, equity, debt, bank loan, you have to pay return to three parties. Okay. And bear three costs. One to equity holders, KE, one to debt holders, KD, and one to bank, KB, obviously on their respective proportions. And if you have raised finance from four sources, it has to pay return to four parties, bear four costs, KE, KD, KB, KP, but all on their respective proportions. Okay. Now, once you have made the equation, the second step is calculate the desired variables. The second step is calculate the desired variables. Now, in any given circumstance, the maximum variables which you have to calculate is 8. E, D, B, P. These four, and KE, KD, KB, KP. These are the 8 variables which you will be needing. Once you get these 8 variables, make the equation, find the variables, that's it. What is E? E is called market value of equity. It's found as number of ordinary shares into current share price. E is the market value of equity. It's number of ordinary shares into current share price. Similarly, P is the market value of preference shares. It's number of preference shares into current share price. Both E and P are almost the same. E is just the market value of equity. You take number of ordinary shares and multiply by their current share price. And P is the market value of preference shares. You take number of preference shares instead of ordinary shares, multiply by their current share price. Okay. B is the market value of bank loan, and D is the market value of debt. So E is the market value of equity, D is the market value of debt, B is the market value of bank loan, P is the market value of preference shares. Okay, I have told you how to find E and how to find B. I will tell you during the question how do you get D and B. Okay. What about these four? KE, KD, KB, and KP. Now KP is found by doing this. Preference dividend per share over market price of preference share. Preference dividend per share over market price of preference share. This is how you get KP. Okay. For KB cost of bank loan, listen carefully. Either it's given, and if not given, assume it's same as KB. Either it's given, if it's not given, assume it's same as KD. Okay. For KE, two models are applied, either DVM, dividend valuation model, or CAPM, capital asset pricing model. If dividend valuation model is applied, KE is determined like this: D1 over P0 plus G. You might have witnessed these formulas in your studies. And if CAPM is applied, KE is RF plus RM minus RF beta equity. Okay, I will write the abbreviations shortly on the next screen. Okay, so for KE, if it's a dividend valuation model question, you will know it in the question, then D1 over P0 plus G. And if it's a capital asset pricing model, it's RF plus RM minus RF beta equity. Okay. And for KD, if debt is irredeemable, it's interest upon market price. If debt is irredeemable, it's interest upon market price. And if debt is redeemable or convertible, it's determined through IRR approach. Okay, so this is the complete sketch which I have made. I will be explaining all of these stuff to you, but first please note it down so that we can then explain you in detail. This is the golden sketch of weighted average cost of capital. It's RF plus RM minus RF beta equity. Manur, you can see if it is discussed, then fine, else you can message me after the class, so we will provide you some support regarding that. It's interest over market price, Subail. Ali, interest paying instruments always give you tax benefit because they reduce your profit and reduce your tax. That's why we do 1 minus T only on interest paying instruments. Yes, Ahmed, this can come in MTQ as well, OTQ in section B as well as section C. Yes, Ali. Okay, so let's just wrap it up via a quick summary and explanation of these terms so that we can immediately move to the question. I told you that when question asks you to find WACC, so remember it is asking you to find cost of capital. If anyone asks you to tell them what is the cost of capital, you must ask them, please tell me how many sources you are financed from, then only I can tell cost. So the first step is whenever question asks you to find WACC, look at the balance sheet to see from how many sources company has raised finance and make equation. Okay, I told you if company is financed to two sources, obviously it has to bear two costs of raising finance. Two costs, one to equity holders KE, one to debt holders KD. WACC is KE plus KD, but on their respective portions. Okay, equity proportion and debt proportion. If it's financed to three sources, then it has to bear three costs KE, KD, KB on their respective portions. And when it's financed to four sources, bear four costs KE, KD, KB, and KB on their respective proportions. Okay. Then once you have made the equation, you need to find variables. What maximum number of variables you need? E, D, B, and P. Obviously in a question it can be 3, it can be 2, it can be 4. E is market value of equity, number of ordinary shares into current share price. P is market value of preference shares, number of preference shares into current share price. D is market value of debt. I will tell you how to calculate. B is market value of bank. Okay. And then you need four more things. KB, either it's given or assume same as KD. KP, I've told you, preference dividend per share over market price of preference shares. KD, if debt is irredeemable, it's a formula. Interest over market price, if it's redeemable or convertible, apply our method. And for KE, there are two methods. Dividend valuation model, which states KE is D1 over P0 plus G. D1 stands for next year's dividend. G stands for growth rate, and P0 stands for current share price. Ex dividend. Ex dividend means excluding dividend. And the other method is called CAPM. CAPM states KE is RF plus RM minus RF into beta equity. RF stands for risk-free rate of return. RM stands for market rate of return. BE stands for beta equity, the company's beta, how much risk it is facing. Okay. And this whole bracket, sometimes it's given together. This whole bracket is given together. RM minus RF. This bracket is called risk premium. So either you will be given a market rate and a risk-free rate. You need to take market rate first and risk-free rate second. If risk premium term is given, that means the whole bracket RM minus RF is given together. Okay, please copy it. Now we will be moving towards the questions. Yes, Aves, it is. Yes, Ali, you are right. Assam, beta equity is the risk factor of the company, how much risk it is facing. It's the risk factor of the company, how much risk it is facing. Now, as far as the questions are concerned, you have a handout file with the name of session.document. You can download that file because you can see question from that file. I will be showing the question on the screen. You can see the question from your session document file which has been provided to you. The question which we are going to attempt, it's from March-June 2019 attempt of ACCA. It's on page number 2 of your handout file which has been shared with you. This is the question name called Corfe Company. This is the question from the handout file which has been shared with you. And let's start from the question, and handout file is attached in the GoToWebinar tab. Not yesterday's one, today it's a new file called session.document. Okay, now let's just read the question, and I will attempt this question as per the technique which is just taught to you. Okay, I will attempt this question as per the technique which is just discussed with you. Okay, 2 steps I have told you to find back: a question and then finding variables. Okay, let's start. The following information has been taken from the statement of financial position, balance sheet of Corfe company, a listed company. So the following information has been taken from the statement of financial position of Corfe company, a listed company. Okay, information is taken from the balance sheet, financial position of Corfe company, a listed company. Look at the information. Non-current assets are 50 million. Current assets have cash and cash equivalents 4 million, other assets current 16 million, 20, and total assets become 50 and 20, 70 million. Okay. Equity and reserves are ordinary shares 15 million, reserves 29 million, total equity is 44. Non-current liabilities have 6% preference shares 6 million, 8% loan notes 8 million, and a bank loan of 5 million. Current liabilities are 7, total equity liabilities are 70. This is the balance sheet. Non-current assets, current assets, equity and reserves, non-current liabilities, preference shares, loan notes, bank loan. Now see, it's giving information about everything. The ordinary shares of Corfe have a nominal value of 1 per share and an ex-dividend market price of 6.1 per share. So ordinary shares have a par value of 1 and market price of 6.1 per share. Par value is 1 per share, but market price is 6.1 per share. A dividend of 0.9 per share has just been paid. Okay. The 6% preference shares of Corfe company have a nominal value of 0.75 per share and market price of 0.6 per share. Don't mix these two statements. In the above paragraph, the ordinary shares information was given that ordinary shares have a par value of 1 and market price of 6.1. Dividend of 0.9 has just been paid. Now its preference shares have a nominal value of 0.75 per share and market price of 0.64 per share. The 8% loan notes of Corfe have a nominal value of 100 per loan note and market price of 103.5 per loan note. Now it's information about loan notes that they have a nominal value of 100 and market price of 103.5. Annual interest has just been paid. Loan notes are redeemable in 5 years time at 10% premium to nominal value. So it's a very important statement that loan notes, debentures are redeemable. The bank loan has a variable interest rate. Okay. The risk-free rate of return is 3.5% per year and risk premium is 6.8% per year. Corfe has an equity beta of 1.25 and pays tax at a rate of 20%. Please pay attention. You have the information that when you look at the balance sheet, so the balance sheet has some non-current assets. Balance sheet has some current assets, total assets, equity, ordinary shares, reserve, preference shares, bank loan, everything. It provided you information that ordinary shares have a par value of $1 per share. Now, if you look at the balance sheet, you are seeing, I'm seeing that in the balance sheet, ordinary shares are 15 million. Okay. In the balance sheet, as you can see, ordinary shares are 15 million. You can clearly see ordinary shares are 15 million. And in the paragraph, it states ordinary shares have a par value of 1 per share. So if ordinary shares have a total capital of 15 million and par value is $1 per share, that means number of ordinary shares are 15 million, because the worth value is $15 million and ordinary shares have a par value of $1 per share. So that means the number of ordinary shares are 15 million. Okay. Similarly, if you talk about preference shares, I can see the 6% preference shares in balance sheet at 6 million. So the worth of preference shares is $6 million. And it says the 6% preference shares have a nominal value, par value of 0.75 per share. So if my total worth of preference shares is 6 million and par value is 0.7, I will divide it. That means 8 million is the number of preference shares. Like for example, 6 million is the worth of preference shares and par value had been 0.5. I would have divided it to get number of preference shares 12 million. But 6 million is preference shares, 0.75 par value. So we divide it. Number of preference shares are 8 million. Any queries with these 2 points? No need to copy. We will solve it on the spreadsheet. Okay, so if I look at the question again, I was provided with the balance sheet, and then in the balance sheet later paragraphs were ordinary shares of a par value of 1, market price of 6.1. Ordinary shares par value was given, so I calculated number of ordinary shares. Preference shares par value was given, so I calculated number of preference shares. Loan notes have a par value of 100, market price 103.5, bank loan has a variable rate, risk-free rate 3.5%, premium 6.8%, as equity beta 1.2, tax rate is 20%. Investment and facilities. Corfez board is looking to finance investment in facilities over the next 3 years, forecast to cost up to $25 million. So Corfez board is looking to finance investments in facilities over the next 3 years, forecast of cost up to $25 million. The board does not wish to obtain further long-term debt finance and is also unwilling to make equity issue. So Corfez board is looking to finance investments. They are expected to cost 25 million. Board is not wishing to raise debt and it's not wishing to raise equity. This means investments have to be financed from cash which can be made available internally. Obviously, if you are not planning to raise cash via equity or debt, you have to raise the cash internally. Board members have made a number of suggestions about how this can be done. Director A has suggested that the company does not have a problem with funding new investments as it has cash available in the reserves of 29 million. If extra cash is required soon, Corfez could reduce its investment in working capital. See in the balance sheet, company has reserves of 29 million, right? See in the balance sheet, company has reserves of 29 million. You're seeing reserves of 29 million. So Director A has suggested company does not have a problem with funding new investment as it has cash available in the reserves of 29. If extra cash is required, it could reduce investment in working capital. Director B has suggested selling the building, which contains the company's headquarters in the capital city for 20 million. B has suggested that you need 25 million. Sell the building of the company's headquarters for 20 million. This will raise a large one-off sum and also save ongoing property management costs. Head office support functions would be moved to a number of different locations rented outside the capital city. Director C has commented that although a high dividend has just been paid, dividends could be reduced over the next 3 years, allowing spare cash for investment. I think that's it. In this paragraph, it was mentioned that Corfez board was looking to finance investments which are expected to cost 25 million. They don't want to raise debt. They don't want to raise equity. Investments must be financed from internal cash. Board members have suggested, Director A has suggested use reserves. B has suggested sell company's headquarters, and C has suggested reduce dividends. There are 2 requirements worth 11 marks and 9 marks in this examination question. Requirement A, calculate the after-tax WACC, weighted average cost of capital of Corfez on a market value basis, 11 marks. And then B, discuss the views expressed by the directors on how investment should be financed. You have to discuss the views of the three directors, 9 marks. We'll solve both of them. First requirement, calculate the after-tax WACC of corporate company. Okay, so calculate the after-tax WACC of corporate on a market value basis. This is part A, and this is the first requirement which I'm doing according to the technique just discussed with you. Okay. Obviously, I think you have understood this point that first Corfez balance sheet was given and information was given. From that, you can find back first part, 11 marks. And then there was some views of three directors. That's only related to part B, 9 marks. So we don't have to focus on this director's views to solve the first part. Okay, let's start. Since the questioner asks you to find WACC, remember I've told you there are 2 steps. First step, look at the balance sheet to see from how many sources company has raised finance to make equation of WACC. The first step is look at the balance sheet to see from how many sources company has raised finance to make the equation. If you go and look at the balance sheet, to make the equation of WACC, look and go at the balance sheet. You can see that company is financed from how many sources? Are you seeing equity ordinary shares? Yes. Are you seeing debt loan notes? Yes. Are you seeing bank loan? Yes. Are you seeing preference shares? Yes. So in short, this company is financed from all 4 sources: equity, ordinary shares, debt, debentures, loan notes, bank loan, and preference shares. Since company is financed from 4 sources, how will you make equation of WACC? Since company is financed from 4 sources, it has to give return to 4 parties. Give return to equity holders first, bear a cost called K. Give return to debt holders, bear a cost called KD 1 minus T. Then it has to give return to bank, bear a cost called KB 1 minus T. And then it has to give return to preference shareholders, bear a cost called KB. So since company is financed from 4 sources, you are asked to find cost of capital. You must know how many cost company is bearing. Company is financed from 4 sources. It has to give return to 4 parties, bear 4 costs. Give return to equity holders, bear a cost KE. Debt holders, bear a cost KD. Bank, bear a cost KB. Preference shares, bear a cost KP. So the equation of WACC would be KE plus KD plus KB plus KP. But remember, all costs will come on their respective proportions. KE would only come on equity proportion, and equity proportion is KE into E over E plus D plus B plus P. Okay, then cost of debt will only come on debt portion. Debt portion will be debt over all four. Okay, then cost of bank loan will only come on bank loan portion. If company is financed from four sources, the bank loan portion will be bank loan over all four. And KP, preference shares, the fourth cost company has to bear, that is only on preference share portion, which is preference share over all four. So this was the first step which you have done successfully, that since company was financed from four sources, it must bear return to four parties and bear four costs. Give return to equity holders, bear a cost KE. Give return to debt holders, bear a cost KD. Give return to bank, bear a cost KB. Give return to preferential shareholders, bear a cost KP. The equation of WACC would be KE plus KD plus KB plus KP on their respective proportions. Okay. Any questions with respect to step one? Yes, ma'am. Now, once you have made the equation, step one is over. Now you must go towards step two. Calculate required variables. So you must calculate the required variables. What variables you need? You need in the equation, look at the equation, what variables you need? You need E, D, B, P. You need these four. And then you need KE, KD, KB1 minus T, and KB. By looking at the information, you can see that you need E, D, B, and P. And then you need, how will I know which variables I need? I will look at the equation. I will be needing E, I will be needing D, I will be needing B, and I will be needing E. Whatever I am doing, Hamza and Mania, you need to follow that, okay? Now let's start finding all these variables. Remember what I told you about E. E is the market value of equity. Okay. What did I tell you about D? It's the market value of debt. What did I tell you about B? It's the market value of bank loan. And what did I tell you about P? It's the market value of preference shares. So let's find these four things: E, market value of equity; D, market value of debt; P, market value of bank loan; P, market value of preference shares. Now, how do you get market value of equity? Please pay attention. I told you here, market value of equity. Remember market value of equity? It's number of ordinary shares into current share price, and market value of preference shares, number of preference shares into current share price. We will get them easily. Now, number of ordinary shares, we have 15 million capital and $1 par value. We have already found the number of ordinary shares are 15 million and current share price of ordinary shares are 6.1. You can read the question. Ordinary shares have a nominal value of 1 per share and market price of 6.1 per share. So if ordinary shares are 15 million and they have a $1 par value, we have already calculated number of ordinary shares as 15 million and current share price of ordinary shares, it's 6.1 per share. So number of ordinary shares 15 million into current share price 6.1, this will give you market value of equity. So let's do it. Number of ordinary shares 15 million into current share price of ordinary shares, that's 6.1, you get market value of equity. Okay, number of ordinary shares 15 million into current share price 6.1. Similarly, how will you get the market value of preference shares? You have already calculated 6 million is the preference share capital and par value is 0.75. You can divide it to get number of preference shares. Remember, number of preference shares are 8 million and current share price of preference shares is 0.64. Okay, preference shares have a par value of 0.75. So number of preference shares 8 million, current share price is 0.64 per share. So number of preference shares are 8 million into current share price of preference shares is market value of preference shares is also generated. Okay, so you've got the market value of equity, number of shares 15 million into current share price. We've got the market value of preference shares, number of preference shares into current share price. Now you need market value of debt and market value of bank loan. Bank loan. What is the value of bank loan? 5 million in the balance sheet. The bank loan's market value is 5 million. And remember, bank loan is not a tradable instrument. You don't trade it. When you take loan from the bank, you don't trade it. Okay, shares are traded, debentures are traded, but bank loan, when you take loan from the bank, it's never traded. So the balance sheet value of bank loan is 5 million. Since it's not traded, the market value is always going to be the same as balance sheet value 5. Since it's not traded, the market value of bank loan 5 million and the balance sheet value are always going to be same. Okay, and market value of debt. What is the debt loan note value in balance sheet? 8 million. The debt loan note value in balance sheet is 8 million. So loan note debenture value in balance sheet is 8 million. What's written? The 8% loan notes have a nominal value of 100 and market price of 103.5 per loan note. There are 8 million loan notes. They have a par value of 100. That means they have official value of 100. But the market price is 103.5. They are trading at 3.5% more than the par value. So the market price is going to be 8 million, 3.5% extra. Had it been written, they are trading at 105 per loan note. That means the 100 loan note is trading at 105, 5% extra. Had it been written, they are trading at market price of 110 per loan note. That means 100 loan note is trading at 110, 10% extra. If it's written, it's trading at 90 at market price. That means 100 loan note is trading at 90, 10% less. We would have reduced 10%. But this is trading at a market price of 103.5, 3.5% extra. So we will convert this 8 million into 3.5% extra. So 8 million is the balance sheet value, trading at 3.5% extra, 103.5%. So out of these 8 variables required from the equation, you have generated 4 of them. Any questions, please ask. Yes, Bahir, I'm showing. It's number of preference shares into current share price. I'm showing step by step the equation of EDBNP. Please pay attention. This is E. Number of ordinary shares 15 million into current share price. This is P. Market value of preference shares. Number of preference shares 8 million into current share price 0.64. B is the market value of bank loan. It would remain same as balance sheet value. And this is the market value of debt. See, in the balance sheet, debts have a value of 8 million. They are trading at 103.5. The 100 loan note nominal value has a market price of 103.5. That means it's trading at 3.5% extra. So I increased this 8 million by 3.5% extra. Had it been said it's trading at 105 per 100, that means 5% extra. I would have increased by 5%. Okay. Piyusha, preference shares is 6 million in monetary value. The formula which I have told you, it's number of preference shares. So 6 million is the preference share value and it's trading at 0.75 nominal value. So you need to divide it first to get the number of preference shares. That's 8 million. Jawad, there is no formal presentation technique. If you want to do it that way, you can do it that way. No problems in that. Shahab, this question, Shahab, is irrelevant here because it's clearly written the shares can be redeemed after 5 years. So there is no point of convert. Okay, now you have to pay attention to the last 4 things because once these 4 things are calculated, I just have to place them in the formula and get 11 marks. Okay, let's find KE now. Now I have told you that for KE, you have 2 models. One is CAPM, one is DVM. The formula of DVM is D1 over P naught plus G, and the formula of CAPM is RF plus RM minus RF beta equity. If risk-free rate, market rate is given, always use CAPM. If risk-free rate, market rate is given, always prefer CAPM. So KE will be found through CAPM, which is RF plus RM minus RF into beta equity. Okay, so K would be found like this: RF plus RM minus RF beta equity. Please go back to the question now. In the second last line, you can see risk-free rate is 3.5%. Okay, you are not provided with market rate. It's given risk premium 6.8. The whole bracket is given, and equity beta is 1.25. Remember, market rate is not given. Risk premium is given. Whole bracket is given. Okay. So let's just put them in the formulas. The risk-free rate is 3.5%. I'm directly doing in decimal, 0.035 risk rate plus RM minus RF. Had you been given the market rate, I would have taken that. But as you can see, market rate is not given. Risk premium is given 6.8%. That means whole bracket is given 0.068. Had it provided you market rate, I would have taken that, then deducted risk rate. If premium is given, that means whole bracket is given 0.068. Multiply by beta equity. So beta equity is 1.25. You can see it clearly. I have recorded RF, I have recorded RM minus RF, the premium bracket, and beta equity. Okay, you can note them. I will just press the enter and I get KE 12%. Vanya, I've told you whatever I'm writing, you must write that. Okay. Now for KP, I have told you the formula of KP. Remember, it's preference dividend per share upon market price of preference share. It's preference dividend per share over market price of preference share. So as you all know, to get the preference dividend per share, we will refer to the question. Preference dividend per share. You know, preference dividend is paid at 6%. Preference dividend is paid at 6%. This percentage mentioned is the preference dividend percentage. Preference dividend is 6%. 6% of what? Preference dividend per share. So preference dividend is 6%. 6% of what? Always the par value. And the par value is 0.75. So 6% of 0.75. This is the preference dividend per share. 6% of 0.75. This is the preference dividend per share. 0.045. This is the preference dividend per share. Upon the market price of preference shares. What is the market price of preference shares? 0.64. Okay. To find the KP, cost of preference shares, we take preference dividend per share over market price of preference shares. So we all know the market price of preference share is 0.64. The market price of preference share is 0.64. What is the preference dividend per share? So preference dividend per share, the percentage mentioned is of preference dividend, 6% of what? Always par value. So par value, nominal value is 0.75. This makes preference dividend per share over market price 0.64. This will make it 7% approximately. You can note this. Preference dividend per share over market price, that's the formula. So market price of preference share, it's given 0.64. We take that in denominator. And preference dividend per share. Preference dividend is how much dividend we are paying. The percentage mentioned of preference dividend in balance sheet is 6%. 6% of what? Always par value. So par value was 0.75. So 6% of par value 0.75 gave you preference dividend per share. And the market price was 0.75. This gave you KP. Now I told you about KB, that it's usually given, and if it's not given, I will assume it's same as KD. Okay, so if I go and search the question, there is no percentage mentioned for bank loan. There is no percentage mentioned for bank loan. It's just stating that in the third last paragraph that the bank loan has a variable interest rate. So the bank loan percentage is not mentioned. So I will assume it's same as KD. So the last thing now I need to know is the cost of debt KD. Now for the cost of debt KD, I have told you if it's irredeemable, we apply a formula. If it's redeemable or convertible, IRR. It's clearly mentioned that loan notes are redeemable in 5 years. So when loan notes are redeemable, we use IRR approach. When it's redeemable, we use IRR approach. So they are redeemable in 5 years. Interest is 8%. Okay, we use IRR approach. It's not given, we will assume same as KD. So we will now apply the IRR approach. Okay, applying the IRR approach. Please pay attention to this IRR approach for KD1 minus T. Now the loan notes are redeemable in 5 years. So we will make 3 columns, 0, 1 to 4, and 5. Since they're redeemable in 5 years, we will make 3 columns, 0, 1 to 4, and 5. Now a debenture carries 3 cash flows. A debenture carries 3 cash flows. Firstly, the investor comes and buys the debenture at market value. Then he gets interest income on debenture after tax. And then he gets redemption proceeds. IRR approach for cost of debt. So remember, this debt is redeemable after 5 years, right? This debt is redeemable after 5 years. Okay, so this will be done through IRR. 3 columns for 5 years, 0, 1, 2, 4, and 5. A debt carries 3 cash flows. Investor comes and buys debt at market value, incurs outflow, then interest income after tax and redemption process. Okay, let's start. Market value. Investor will come and buy the debt at market value. This will create outflow from his pocket. What is the market value? 103.5. This will be an outflow from his pocket. On that debenture, he will earn interest income after tax for 5 years. So what is the interest income after tax? 8% loan notes, they pay interest of 8%. 8% of what? Always par value. Interest and dividend is always on par. So 8% of par value. Interest income is 8. This is an inflow. But he will have to pay a tax of 20%, 1.6. So interest income after tax would be 6.4 each year for 5 years. For 5 years, this will be his interest income. Okay. Let me do this here again. Interest income after tax. Interest income was 8%. 8% of what? Always the par value, 100. So interest income was 8. But obviously, when you will earn interest income, you have to pay 20% tax on it, 1.6. So the net interest income would be 6.4. That's inflow for the investor. And then in the last year, he will get redemption proceeds. If it states they are redeemed at par, he will get redemption proceeds of 100. Since it's written it's redeemed after 5 years at 10% premium to par, that means they're redeemed at. These are the cash flows which a bond usually carries. Market value, investor purchases, outflow from his pocket. He gets interest income after tax and then redemption proceeds. Okay. Once you get them, net them all. Net cash flows. Negative 103.5. Positive 6.4 and positive 116.4. Multiplied with discount factor. Take any discount factor, 8%, 10%, 5%, 6%, take any discount factor. That's IRR, trial and error method. Let's take 6%. Look at the factors at discount factor 6 from the table. Year 0 factor is 1. Next factors I will go at the table. 6% factor for year 5 from present value table, because separate year is for present value table, 0.747. And for 1 to 4 years, we will look at annuity table. 6% for 4 years annuity table, it's 3.465. Net cash flows will be multiplied by discount factors to get present values. And when you net them, you get NPV. You see, it's 5.6 positive. You see, it's 5.6 positive. Now, when you get positive NPV, obviously you need a negative NPV. Now, to make NPV negative, you need to rate the discount factor, increase the discount factor, take any 8%, 10%, 12%, take any factor. Let me take 10%. 1 for year 0, 1 to 4 from annuity table at 10%, 3.170. Year 5 separately, so from present value table, 0.621, 10% year 5. Now net cash flows will be multiplied by new factor to get new present values. Obviously, firstly, net cash flows were multiplied by these factors to get present value. Now net cash flows will be multiplied by these discount factors to get present values. And when we will net them, we will get NPV. See, it's negative. So you have got the positive NPV and you have got the negative NPV. Once you get the positive negative NPV, you need to put them in the formula of IRR. You need to put them in the formula of IRR. Now we know what is the formula of IRR. The formula of IRR, just for the sake of recap, I am writing it here. small a plus capital A over capital A minus capital B into small b minus small a. So small a is believed to be the rate of positive NPV. Can you see the rate of positive NPV? It's 6%. Positive NPV is at 6%, 0.06. Plus capital A. Okay. Capital A is basically the positive NPV. Okay. So capital A is the positive NPV. You can see positive NPV is 5.6268, or you can take the cell K17 over again capital A. Capital is K17 minus capital B. It's the negative NPV. What is the negative NPV? It's K22 into small b is the rate of negative NPV. Negative NPV is at 10% minus small a, positive NPV, 6%. 7% is the IR. Okay, you can check the formula again. 0.06, that's small a, positive NPV rate, plus capital A, positive NPV. It's K17 over capital A, K17 minus capital B, K22 into small b minus small a. Okay, this produces IRR of 0.073. Okay, I will write this as KD 0.07, and whatever is KD I'm assuming same as KB. Okay, so now I've got all 8 variables. I just have to put them in the formula to get WACC and earn 11 marks. In the meantime, you can copy IRR and ask me any questions. Then I will finally put it in the above equation to get WACC, and then we will take a break. There are many questions which don't ask any logical explanation, and they're just trying to figure out that the way I do, we could have also done like this, we could have also done like this, we could have also done like this. Who is stopping you in presentation using any function? Who is stopping you? If you want to do it like that way, but obviously it should be that you should not impose your preferred method on your friend or me. I should not impose my method on you. So it's acceptable. If you have any problem in conceptual discussion, it's a good thing, but the presentation, that doesn't matter. You can use other methods. Simple. Alian Heather, actually the IRR is a trial and error method. That's the basic concept of IRR. Okay, the percentages are to be guessed on our own. Okay, so use 10%, use 5%, use 4%, use 3%, and check it when the class is over. You will get the same IRR of 7% as I am getting. So no worries about it. Yes, Amir, in interest after taxes, that you get 8% interest of par value 100. So 8 is your interest income, but after tax, 20% tax paying, it becomes 6.4. Yes, Aman, you can take and get the same answer. Hamza, I've written the IRR formula equation. Small a plus capital A over capital A minus capital B into B minus A. Trial and error means your guess. That I want to use the function, please use it. There is no problem in that. Yes, so now that's acceptable. And I have told this thing multiple times that once I complete this WACC equation, and find the WACC. We were going on the break, so just please wait for 5-10 minutes. Yes, Mohammed Ali, I will do it. Now, Bassam, IRR is the internal rate of return. If you need to ask what is IRR, so I think you need some basic classes as well. So please contact me after the class. Thank you. It's 0.0733. Sana, if you are doing working on the calculator and just putting values, then you need to write the formula. If you're doing like this, I have shown the complete formula in my working, so no need in that case. Okay, so I think we are now wrapping this question by just doing one last working. I informed you that this question asks for WACC, and the only time consuming thing is this IRRKD. In WACC, there are two steps. The first step is make the equation by looking at balance sheet. So you looked at balance sheet, their company was financed from four sources: equity, debt, bank loan, preference shares. So it had to pay return to four parties, pair four costs: KE, KD, KB, KP on their respective portions. Step two, once you make the equation, you need the variables. E market value of equity is number of ordinary shares into current share price. You got it. D market value of debt, 8 million trading at 103.5. B market value of bank loan, same. Preference share, same. KE was RF plus RM minus RF beta equity. KP was preference dividend per share over market price. KB was not given. I will assume it as KD. So KD is IRR. 5-year redemption. 3 transactions, market value outflow, interest income after tax, redemption. Net cash flow, take any factor, get positive NPV, increase it to get negative NPV, and get IRR. Okay, IRR is KD. And I have assumed it same as KB. Okay. Now, once you have all these 8 things, see, you can just put them in the equation to get WACC. For WACC, it's better you create this E plus D plus B plus P, because you will be needing that. So E plus D plus B plus P is the sum of all these E, D, B, and P. Now let's just check my working. I am putting everything in the Excel formula, okay, and finding WACC. WACC is, please pay attention to the formula, bracket open, KE. What is KE? K is in cell B13. K is in cell B13. Okay, K is in cell B13. Into E. E is in cell B8 over E plus D plus B plus P. This is in cell B12. First bracket is done. K B13 into E B8 over all 4 B12 plus KD1 minus T. KD1 minus T is in cell B14. Steric D. D is in cell B9 over E plus D plus B plus P. That's in B12. Second bracket done. Plus KB1 minus T. KB1 minus T is in cell B15. B15 into B. So B is in cell B10 over E plus D plus B plus P. That's B12. Okay, bracket closed. Plus final KP. KP is in cell B16 into P. P is in cell B11 over E plus D plus B plus P, all four, B12. That's it. Enter. %11.2% is your final WACC. 11.2% is your final WACC. Okay, I am opening the formula. You can copy it if you want. We are going on a 15-minute break and we will resume it once we are back. Okay. Okay, so welcome back. And a question is there that corporation tax is of no use in the question. We have used the corporation tax, right? You can clearly see that the interest income after tax is basically 8%, and then we took after tax 20%, 1.6 deducted, and then 6.4. So tax was used in this question. Okay, so now we will be moving towards part B of the question, and then we will be going towards the next question. So what is the part B of this question? Corfez board is looking to finance investments facilities over the next 3 years. Corfez board is looking to finance investment in facilities over the next 3 years, forecast to cost 25 million. So they are looking for investments which are going to cost 25 million. Board does not wish to obtain long-term debt and is unwilling to make equity, neither debt nor equity. This means investments have to be financed from cash which can be made available internally. Board members have made a number of suggestions about how this can be done. The problem is they are looking for investments that cost 25 million. They don't wish to obtain further funding through debt or equity, so they need internally generated funds. Board members have made a number of suggestions. Director A has suggested company does not have a problem with funding new investments as it has cash available in the reserves of 29 million. So as you can see in the balance sheet, there is cash available of 29 million. So Director A says that use that. Director B has suggested selling the building which contains headquarters for 20 million. This will raise large one-off sum, will save ongoing property management costs. Head office support functions will be moved to a number of different locations rented outside the capital. Director C has commented that although a high dividend has just been paid, dividends could be reduced over the next 3 years, allowing spare cash for investment. Company needs 25 million, and 3 directors have given their suggestions. Requirement B is worth 9 marks, which seems a lot. Discuss the views expressed by the 3 directors on how investment should be financed. You have to discuss the views expressed by 3 directors. Basically, you have to discuss the views expressed by 3 directors. There are 3 directors. Director A, Director B. Both have given their views. This director has said use reserves. This director has said sell companies, building. And this director has said reduce dividends. So you need to discuss the views of each director. Now the problem is when students are asked to discuss the views of each director, students say we don't know. What is the meaning of this? Discuss the views. Students say we don't know the meaning of this. That what is meant by this? Discuss the views. Now the view of director A is use reserves. If someone says you discuss his view, you need to state the pros and cons, advantages, disadvantages, agreements, disagreements, points in favor, points in against of his view. That's it. I say F9 is very easy and ask you, discuss my view. This is my view. F9 is easy. Discuss my view. So you should write either you support this view or negate this view with justifications. Director B says sell building to raise cash. Discuss his view, whether you agree or disagree. Advantages, disadvantages, pros and cons. Director C says reduce dividends. Discuss the view, whether you agree or disagree. Pros and cons. If you write three points of each director's views, for and against, either for, either against, three points. That's it. Like the easiest views to discuss of Director B. He has said that you must sell company's building. Okay, this will raise cash. Okay, and headquarter can be moved to different locations, rented. Okay, discuss it. Director's B view is to sell building. This will raise cash, but may result in loss of capital gain, right? Because if you sell building and property, the future appreciation, you will miss that chance. Okay, so you can write this, that director's B view may raise cash but may result in loss of capital gain. What else is saying? This will raise a large one of some, also save property maintenance cost. Will save property maintenance cost but increase monthly maintenance, right? What does this mean? You are selling your property. Obviously, when you sell your property, you will save property maintenance cost, but you are moving to a rental location. So rental location creates maintenance cost. So one way you are saving the property maintenance cost, and the other way you are increasing the monthly rent. Okay, maintenance cost will increase. Rental will increase. Obviously, when you will shift, rental cost will increase. Centralization will be lost. Again, I am not saying that you should write just this point. You need to obviously elaborate them. At the moment, the building is headquartered, so all places are at one place. Centralization, it saves money. Then moving functions to other places, obviously decentralization, and this increases cost. Sir, all the views we have written are against this. There is no compulsion that you need to write view in favor. My view is that his proposal doesn't seem good because the anti points are more. Still, if you want, you can write favorable point as well. What is the favorable point? No need to raise cash from debt or equity. Obviously, you have your own property, you are selling that to raise cash for this investment. That means you don't have dependency to raise cash from somewhere else. So see, I have written 5 points with respect to director B. Okay, come to director A's views. His view is to use reserves of 29 million to fund this. Now, his view seems incorrect completely, because reserves of 29 million does not mean company has 29 million cash, right? Reserves doesn't mean you always have that cash available. So reserves of 29 million doesn't mean you have reserves of 29 million, doesn't mean you have cash of 29 million. So how will you fund this investment? You need 25 million. Reserves may be non-cash as well. So his view needs to be rejected, as we can't fund investment through his view. Director C view, reduce dividend, because if you reduce dividend, you save money and then you can invest. As you have all studied in sources of finance in your normal classes, dividend has a signaling effect. Reduced dividend is a signal of demotivation for investors. Why do investors invest money in the company? To earn something. If you are saying that you will reduce dividend, obviously it will give signal that we are not earning enough return. So if we are not earning enough return, we may go to some other company, sell our shares, reduction in fall in share price, investors' confidence lost in the company. So his view also doesn't seem. What companies can do is company can slowly and gradually reduce dividend. Then this point will be workable. At the moment, reducing it by 25 million to fund this seems to be a big bet. So all views are in disagreement majorly. So it is better company does not stick to one director's view and follows every director's view, that rather than director's view of selling a big building, sell some small property or small assets, reduce dividends by a smaller amount. Director's A proposal is completely baseless. Only the cash reserves that can be used. So then company would be able to fund internally. Okay, you can copy these points and do read the examiner's answer as well. Well, Sadamji, this point I have been telling since yesterday as well, that I cannot write the complete theoretical answer because it's a webinar. It's not a complete class. Okay, so these are just the points. Read the examiner answer and elaborate them. Hassam, I will share it with you separately. Okay, at the moment people are copying this. Investors' confidence lost. Hamza Baloch, investors' confidence lost. 250 हो गए? Okay. Now we will be moving towards the next question. Yes, Basam, your point is correct. So, Amir, your question is what will be the conclusion of this question? Which director's opinion is viable? Now, this is the problem which students make. I'm very glad you asked this question. Did the examination question requirement ask you which director's opinion is viable? No, it asked you to discuss each director's view. It never asked you that what is the conclusion, what is the director's opinion viable. So, this is something extra which you are thinking. That's not required. Now, the last question which we'll be doing today is an MTQ of weighted average cost of capital. Okay, so we will be doing this MTQ. Now, this MTQ also belongs to, as you can see, this March-June 2019 examination question. Because in these practice to pass webinars, what we are doing is we are solving past exam questions to ensure we have a sound understanding of what is really coming in the exam. So this March-June 2019 question, it was a question of Tulip Company. It was an OTQ. Okay. Now my first task is that obviously when an OTQ comes, so OTQ is basically having a computation requirements as well as theoretical requirements. Okay, OTQ involves computational requirements as well as theoretical requirements. Okay, so there are two computational requirements and then three theoretical requirements. I'm not sure we will be able to do the last theoretical requirement because it relates to the other section, but we will be definitely doing 4 theoretical requirements at the moment. Okay, now I'm just giving you 5-7 minutes. I want you to read, because you have studied WACC with me now, so I want you to read this scenario and take 5-7 minutes to solve requirements C and D. Sorry, first two requirements. This is 16 and 17. And then after 5-7 minutes, I will share the answers with you. Okay, please start it. Okay, so people have shared their answers, and let's just start it. So this particular question was, Tulip is a large company with an equity beta of 1.05. Company plans to expand existing business by acquiring new factory at a cost of 20 million. Finance for the expansion will be raised from issue of 3% loan notes issued at nominal value of 100. Loan notes will be redeemable after 5 years at nominal value, or convertible at that time into ordinary shares in Tulip with an expected value of 115. Now see, it's not written they will be redeemable after 5 years full stop. It's written they will be redeemable after 5 years at nominal value. What is the nominal value? 100. Or convertible at that time into ordinary shares with a value expected to be 115. This is what convertible is. That either it is redeemed at par value 100 or converted into shares, and the shares have a value of 115. So obviously when convertible is given, you choose the better option. Out of 100 and 115, which is the better option? 115. So the good advantage of this session was that we got a chance to see redeemable as well as convertible. Convertible is also done via IRR. Okay, redeemable is also done via IRR and convertible is also done via IRR. But redeemable is that it's redeemed at par value, full stop, no other option. But convertible is that it's redeemed also or converted into shares having a value of 115. So if it had been redeemable, it would have been redeemed at 100. But since it is also convertible into shares, the value of that costs 115. So it is better to opt for the better option, 115. That's what convertible is. Risk rate 2.5, premium 7.8. Tulip is seeking additional finance using Islamic financing. What is the cost of equity using CAPM? Cost of equity is basically KE. You don't need to perform Excel workings here, spreadsheet workings here, because this is an MTQ. KE using CAPM. So I've just taught you KE using CAPM is RF plus beta equity. Risk-free rate of return is 2.5%. Are you given premium or market rate? Market rate is not given, premium is given. That means it's the whole bracket, 7.8, and beta equity is 1.05. 10.69% is the answer. I will select 10.7. 17. Using estimates of 5% and 6%, what is the cost of debt of convertible loan notes? Please pay attention. It's asking cost of debt KD of convertible loan notes. Now, cost of debt KD, had it been redeemable, IRR, and cost of debt, had it been irredeemable, I told you a formula. Cost of debt, if it is convertible, I told you that if cost of debt of KD of convertible is to be calculated, again IRR. So cost of debt KD of convertible, okay, it's again IRR. So three cash flows in IRR. Firstly, market value, then interest income after tax and redemption. Okay, investor buys bond at market price. What is the market price? So it's issued at nominal value of 100. So since it's issued at nominal value of 100, that means investor will come and buy it at 100. Since it's issued at nominal value of 100, investor will come and buy it for 100. That would be outflow from his pocket. Okay. Then interest income after tax, it's 3% interest of what par value? 100. So interest income is 3 for 5 years. There is no tax in this question. So 3. And redemption or conversion is at 115. We net them all. Now, frankly speaking, in IRR, you can use any discount factors, but here the instruction comes. So you have to follow the instruction, use 5 and 6. So first I will be using 6%. The factors of 6% are 1, 3.465, 0.747. multiply to get present values, and the NPV is negative. Okay, now the other factor is 5%. I need to see the factors of 5% from the table. 5% year 5 is 0.784. And 5% for 4 years from annuity table. 3.546. So negative positive NPV put in the formula of IRR. So we are getting the IRR as approximately apply the formula. Small a is the rate of positive NPV. So rate of positive NPV is there has been a small mistake, I think. So 5% for year 1 to 4, the factor is 3.1 or 3.546. And 5% from year 5 should be from present value table, 0.784. Okay, now small a is the rate of positive NPV, it's 5%. Capital A is the positive NPV. Positive NPV is in K, 22 over capital A minus capital B. K22 positive NPV minus capital B is in K17 to small b minus small a. So small b is rate of negative NPV, 0.06 minus 105. 5.68%, that means 7%, 5.7%. You can see the workings. Any questions with these two you can ask, then I will move forward. Sanaullah Qureshi, using tables will save time. On calculation will take your time. However, it's your choice. The question has instructed to use 5% and 6%. That's why we are using. Saifullah, it's not being redeemed at 100. It's being converted at 115. So Sanaullah, your working is wrong. But you are using calculator and you are saving time and getting the wrong answer. So there is no use of your calculations. But here the answer is 5.68%. How can the answer be B? Please tell me. Okay, now let's move towards two theoretical requirements and wrap up the topic. We will not be doing the last MTQ because it's from Islamic finance, that's from sources of finance. So let's just do the last, these two and wrap it up. In relation to the dividend growth model, which of the following statements is correct? In relation to dividend growth model, that's dividend valuation model, which of the following statement is correct? The model assumes that all shareholders have the same required rate of return. The model assumes a constant share price and constant growth. Model assumes that capital markets are semi-strong form efficient. Model assumes that Tulip's interim dividend is equal to final dividend. Now, to answer a theoretical question, there are two strategies. One, directly capture the correct answer, and the other, remove the wrong ones and get the correct answer. Okay, there are two strategies to answer a theoretical question. One, directly capture the correct answer, and number two, remove the wrong ones to reach the correct answer. Now, in relation to DVM, which of the following statements is correct? If you look at the last statement that's written in your text, the model assumes that interim dividend is equal to final dividend. Interim dividend is half yearly, quarterly, semi-annually. This model assumes that interim dividend is same as final dividend. No model assumes like that whatever final dividend company will pay at the end of the year, the interim dividend half yearly has also be like this. So this statement is wrong. Model assumes that markets are semi-strong form efficient. That's also clearly written in the text. The model assumes a constant share price and constant growth rate. If you look at the disadvantages of DVM, it's written that DVM assumes a constant dividend growth, but it does not assume a constant share price. So this statement is also wrong. So the correct answer has to be A. This was the strategy where I removed the obviously wrong ones from the text, that interim and final are the same. It's clearly not possible that whatever is the half yearly, that should be the final. Efficiency is clearly mentioned in the text. Model assumes a constant dividend growth. That's mentioned in text, but not the constant share price. So A is the answer. And you can also directly capture the other strategy. This strategy is remove the wrong ones and then reach the correct one. But there is another strategy, directly capture the correct answer. If you look at the common sense, option A, model assumes all shareholders have the same required rate of return. Is it possible that company pays every shareholder separate percentages? One shareholder is paid 8% dividend, one is paid 9%, one is paid 10%. That's not possible. Every shareholder is given the same return. This is what dividend model also states. Every shareholder will get the same return. Okay, so option A is correct. कितनी रह गई? नंबर्स कितने रह गए? तुम जब तक करो, ये क्लास खत्म होती है ना, मैं चार्जर इधर लगा दूंगा क्योंकि उधर स्विच नहीं है, मेरे ख्याल में दूर है चार्जर से काफी. Okay, and 19th, the last MTQ. Which of the following statements about equity finance is correct? Now, this is a very important question. Which of the following statements about equity finance is correct? Again, I will read them. Either remove the wrong ones to get the correct answer or capture the correct one. Equity finance reserves represent cash which is available. Additional equity finance can be raised by right issue or bonus issue. Retained earnings are a source of equity finance. Equity finance includes both ordinary shares and preference shares. Now, eliminate the wrong ones. The strategy. Equity finance includes ordinary shares and preference shares. A completely wrong statement. Equity only includes ordinary shares. Equity doesn't include preference shares. It's only include ordinary shares. So this is saying equity includes ordinary shares, preference shares. Wrong. B. Additional equity finance can be raised by right issue and bonus issue. Now, this is a statement of maybe basic level ACCA papers. Additional equity finance can be raised by right issue, but additional equity finance cannot be raised by bonus issue. How can you raise additional finance via bonus issue? Bonus issue doesn't give you anything. Right issue gives you cash, but bonus issue doesn't give anything. So you cannot raise additional finance by bonus issue. Wrong. A has just been discussed. Director A, equity finance reserves represent cash which is available. Reserves not always mean cash which is available. If company has reserves of 10 million, that doesn't mean it has cash of 10 million. If company has reserves of 10 million, that doesn't mean it has cash of 10 million. Okay, reserves can be non-cash as well. This is what I mentioned in director A proposal as well. So this is also wrong, that equity finance reserve represent cash. The correct answer is C, because that's left. Retained earnings are a source of equity finance, and this is the heading in Kaplan text, that retained earnings are a source of equity finance. Okay, any questions with respect to this? One year it was mentioned equity includes both ordinary shares and preference shares. Wrong, equity only includes ordinary shares. Okay, equity finance represents cash. Director A clearly mentioned. Okay, you are asking about 18. DVM assumes a constant growth rate but not the constant share price. That's why B is wrong. No model assumes that interim, half yearly dividend and final dividend are same. Half yearly dividend, final dividend can be different. D is also wrong. No model assumes that markets are semi-strong form, weak form, efficient. So this is also wrong. That's why A. And obviously A is more common sense. A model assumes all shareholders have same return, because if you are a shareholder, I am the shareholder, we both must get same return. Company cannot pay separate returns to each of us. Okay. So I think it was a good coverage of WACC through these two questions, because the question of Corfe which was selected, that had all four sources, because a question which was selected which doesn't had debt or bank loan, you would have missed that working. So obviously Corfe question covered all four areas, and then this MCQ as well. Ahmed Mashal, your question preference share is what? I will answer that because the topic is in sources of finance tomorrow. But at the moment, what we can get is preference share is never equity finance. Equity only includes ordinary shares. When you talk about equity, it's only include ordinary shares. What are preference shares? They can be debt, they can be equity, but that is on sources of finance agenda. Okay, so hope I think you all have understood these 2 points clearly. Okay, and we are practicing on spreadsheet as well. Okay, are these classes beneficial for you or not? Please do share the feedbacks. Okay, so that we get to know that whether these classes are proving to be beneficial. Up till now we have covered 4 questions with you, 2 of investment appraisal, 2 of weighted average cost of capital. So do please share the feedback and then sign off. We will meet in the next session. Take care. As far as webinar uploading is concerned, ACC has mentioned it's available on ACC's YouTube channel. So please go and see that. Thank you. And do share the feedback before leaving, please.